Let's get more on this big drop in U.S. crude oil inventories. Can't believe it. More than 12 million barrels less in storage. We're joined by Robert Yawger, Director of the Energy Division at Mizuho Securities. Robert, always great to talk to you, and thanks very much. Quite a spectacular plunge in inventories.
Largest slide since 2019, Andrew. So, yes, it's a big one. Multiple reasons. U.S. imports were down by 1 million barrels per day in the week. Exports were up about 700,000 barrels a day. And the amount of crude oil that ran through the refinery was up by over 200,000 barrels a day. So that's basically a 2 million barrel a day swing in movement of crude oil. Times that by 7, you get about 13, 14 million barrels. They were calling it 12. It's a big number no matter how you cut it. Biggest since 2019.
Oil moving up, actually, pretty convincingly today. But the speculation that I've seen anyway is that OPEC Plus is likely to just stay the course when it meets this weekend. And no announced production increases or further reductions.
Yes, and yesterday they announced that they're going to have a online meeting rather than meeting in person. Mm-hmm. That implies to me that they just do not want to have to herd the cats, so to say, and have conversations on what they want to do. It seems that the Saudis want to stay where they are or maybe even cut production, while the United Arab Emirates and Iraq, they've increased their ability to produce more barrels lately. They want to put out more barrels. But between all these divergent points of view, considering the fact that the Europeans are going to impose sanctions on Russian oil on the next day, on December 5th, they're going to sit this one out and ride it into January. And I believe we'll see what happens, but it looks like it'll be leave it alone type meeting.
What is your outlook for oil globally? We do keep hearing that industrialized countries have the lowest inventories in decades, or close to that, close to 20-year lows. Is the world oil market tight right now?
It is pretty tight, but the problem is that COVID-0 has killed Chinese demand. China is the engine for demand growth globally for crude oil. Mm-hmm. And without participating for size, it's hard to really bid the market to the moon like it was in March through June. So until that kind of plays out and you start to get Chinese demand coming back, they're probably down anywhere from 600 to 800,000 barrels a day from their peak production or peak import number. They are by far the largest importers in the world. You're not going to get a spike above and beyond like we saw earlier in the year. Of course, we do have the December 5th European Union embargo. Mm-hmm. We have the end of the United States Strategic Petroleum Reserve sales. And those issues should conspire to drive prices a bit higher. I'm talking 90 bid at 100 for WTI, I would tend to think. Also, it's wintertime, so ultimately heating oil levels, which are really beaten down and low, they should also be a contributor to upward prices.
I'm just trying to think about the amount of oil that it sneaks onto world markets. Reuters reporting that Iranian and Venezuelan crude gets out under false papers. What about Russian oil? A lot of it still seems to be making its way onto the world market, albeit at a discount.
Yes, it depends on who's going to look the other way. Generally speaking, Western countries won't, because you have to insure those barrels, and you also have to have shipping contracts, things along these lines that are held to pretty high standards in the West. But the Chinese and the Indians, they're more than happy to kind of look the other way a little bit and get those barrels for a relatively cheap price at a nice discount. Another headline, actually after that 12 million barrel headline hit tape, right after that, the European Union floated that their downward price cap number is going to be at $60. That's still perceived as a pretty, given the Russians, a lot of room to maneuver down around those levels. Mm-hmm. There's barrels down there right now. So the perception is that really is not going to take any barrels off the market. And that's going to allow China and India to legitimately buy barrels at that point. And so, yes, there is an issue with so-called gangster barrels at the end of the day.
Gangster barrels.
Iran and Russia. But, you know, on the other hand, if you take all those barrels off the market, you're going to have prices spike. And then we're going to have another issue with adding to inflation, adding to chances of recession, and you have bigger problems on your hand. That's why the West is largely open to the idea of a relatively high price cap.
Bob, can you talk to us briefly about backwardation and contango? For a long time over the past couple of years, we did see backwardation in the oil futures market, indicating a shortage of near-term supply. But that has been changing, I believe.
Yes, it has. It's changed big time today. In the Brent market, that's the international benchmark. Brent today, the first contract January, traded as much as $1.79 cheaper than the second month January. Can bring a barrel out of the ground today, sell $1.79 more down the curve, just 30 days down the curve. It probably costs them about $1 to store that crude oil. They're making 79 cents by selling it in January, 30 days from now, instead of selling it today. That February contract expires in 30 days. So that's the problem. When producers start stuffing barrels in storage to sell them further down the curve, it just adds to storage, putting downward pressure on prices.